terms of bond markets in the region, South Africa has by far got the most advanced bond market in terms of how debt is listed, how debt is traded, and the liquidity and the ease of being able to trade debt in South Africa is unique across the continent. A new market which is developing is Nigeria. Government debt in Nigeria is recently been included in the JP Morgan Emerging Market GBI index. And this means that many emerging market investors around the world will now start to buy Nigerian bonds. And the market, what triggered the inclusion for Nigeria is that the Debt Management Office in Nigeria has increasingly followed the model which is used in South Africa as well, where they create large benchmark issues that become tradable. Many African debt management offices don't follow the practice of issuing benchmark bonds which become tradable, and they'll issue a 10-year bond each month, which means that they've created a plethora of what were 10-year bonds at issue. And this means that you have a highly fragmented bond market which becomes very difficult to trade. You will, if you wanted to participate in those bonds, then you would buy it at the auction, and you would hope you'd be able to sell it somewhere in the secondary market, because there simply will not be a live active price of that bond in the secondary market. So what happens, there's huge international interest to trade interest rate products in Africa. It's a growing market. It started back in 2006 and has continued to grow over the years as global investors seek to diversify their interest portfolios. So typically what will happen is when a foreign investor wants to trade an African market, they won't trade the bond market, but they'll trade the treasury bill market. Treasury bills and bonds are largely the same product, the debt issued by a government. The only difference is that a treasury bill has got a much shorter tenor. It will tend to have a 3 or a 6 or maybe a 12-month tenor, and they tend not to carry a coupon. And what then happens is the foreign investor will come in, buy it at a certain yield, and they'll hold it up until the maturity of the treasury bill. And when the treasury bill matures, they might choose to roll over the investment into a new treasury bill, or they would just simply withdraw the money out of the market. Those trades have been hugely popular across Africa when opportunities were attractive over the last few years, and certainly where in 6-7 years ago, where you would have a divide between what they would call exotic markets or the less liquid markets like these African markets, and dedicated emerging markets in which South Africa would have found. We increasingly find that foreign fund managers have merged those desks into one, and the same trader who's trading South Africa will be trading Zambian treasury bills as well.